So this is Too Fast to Furious, and it's a joint project with Alfredo Burlando and Mike Kuhn at the University of Oregon. So here is just how, like, in Mexico, or better said, here in Argentina, like how like digital credit in Latin American countries like would look up. And again, the key, I would say, part of the advertisement is the fact that the loan happens like quickly. So speed, we know it's a byproduct of like digital credit innovation, because loans can be accessed like via mobile or internet. So there is digital financial access, but also because the algorithmic scoring actually like helps in terms of like avoiding any kind of like contacts and automizing this further. We don't know though, like what the effect is like in this market, like the effect of like creditor speed, right? In particular, like we don't know, and that's what we're going to be looking at in this paper, like the impact of like digital delivery speed on default and repayment rates. And so what we try to do in this study is to identify like the causal impact of like digital credit provision speed on default, and try to see whether actually like speed can affect this. As John was saying earlier, in terms of consumer protection, like this could be like a very valuable tool, and I'll talk towards the end why this might matter. So we partner with a Mexican like digital lender. We observe like the first, the full set of like first, second, and third time borrowers over a period of like 7 months. And what this means is that we have data on a loan duration, loan amounts, repayment status, dates, as well as like a very limited like set of observable, because we only have access like to administrative data. What we do in the paper is like to leverage the batch processing of like approved loan, which I will explain in a second, to construct, like to use a regression discontinuity design. So how does the loan like takes place in this setting with this digital lender like in Mexico? So there is a single online section in which borrowers like select a loan amount, which goes somewhere between like 1,500 and 3,000 pesos, and a duration that goes from 7 like to 30 days. Then they submit their application and are approved. One very important thing that I want to highlight here is that our data set is made of approved loans. So we don't see like rejections. So then for first-time borrowers, there is a verification process, meaning that after approval, the lenders will actually like call the approved borrower to verify like identity. This takes place only like for first-time borrower. For second and third-time borrowers, it doesn't happen. And then after that, there is what we call a batching process. So after verification, loans are added to an open batch of verified loans, which means that there is this batching process that takes place like 2 to 4 times a day at different times. And then after that, like once the loan is included in a given batch, the lender is going to transmit the first batch of the day, and then the second batch of the day, and then if there is a third one and a fourth one, to a bank. Once the batch receives like gets to a certain like capacity, and then it transmits it to the bank, and all loans in a given batch are immediately like dispersed. So given this specific process, loans that are added first to a new batch are going to remain in the batch queue like longer than loans that are like added last. And this leads to systematic differences in processing times between loans. So essentially, like what we do in our empirical strategy is we identify the discontinuous changes in processing times that are created each time an existing batch is dispersed and a new one is open. And so that's essentially like in a very simplified manner, the intuition behind like our estimation strategy. So missing the batch cutoff increases the mean loan disbursement time. So what this means essentially is that on average, for all borrowers, loans that are submitted just after one of these like proxy like cutoff face an additional like delay of 9.52 hours. Roughly, what this means is that it doubles the amount of time from more or less like 10 hours to more or less like 20 hours for the time that it takes like for a loan. For first-time borrowers, this is an increase of like less than double, is a 62% increase. For repeat borrowers, this is an increase of like more than 200%. So these are like sizable periods of like delay, as we call them, that are somewhat like imposed by the system because of like missing a given cutoff. So then what we do is we use this like delay that is induced by missing a batch cutoff to figure out what's going to be then the impact on repayment, and then like the opposite side is obviously like defaults. So what we find is that missing the batch cutoff, so due to this delay, essentially like loan repayment rates actually like increase. So for the full sample for which there was a delay of roughly like 10 hours, what this leads to is essentially like an increase in repayment of like 5.6 percentage points, which corresponds to roughly like an 8% increase relative like to similar loans that did not experience like the extra delay. Right. And for first-time borrower, the effect is like roughly the same. For repeat borrowers, which face like a much larger like delay, and therefore like there is an additional time to wait in order like to actually like get the money, we have an improvement in repayment rates of 10%. So these are large amount, as John had shown in the descriptive statistics in terms of like defaults. Our lender is the one in the sample that has like the highest default rates of like 27%. Now, the important part is that these are large effects, right, that are due like to a delay of, as I mentioned at the beginning, already approved loans, right? And so what we want to be able to understand is what is going on, right? And so basically like what we want to try and see is what is the mechanism behind like the fact that we have this disbursement friction that causes an increase like in loan repayment. As I mentioned earlier, like we have extremely limited data on our borrowers, and so this is really hard like to do with the data that we have. Nevertheless, like we did try. So the first thing that we do is we rule out like selection. And so selection could explain the results if we were to have borrowers with a low propensity to repay that are more likely to cancel the loan request if the loan delivery like takes too long, right? We check with the data though, and delayed loans are not more likely like to be withdrawn. So then if we discard like selection, essentially what we're left with is not hidden information, but hidden action. And so what we've done next is within like the hidden action / like moral hazard framework, like to try and think about what are other like distinct channels through which like delays can actually like affect repayment. And so what we've highlight are essentially like three. The first one is what we call like an opportunity channel. And so the idea is that the disbursement delays is changing like this set of options that are available like to the borrower. So let's think about, for example, of a bet, right? So let's imagine a borrower that wants to place a bet on a soccer match, which is gonna kick off like at 8 p.m. She applies and she's approved like for a loan at 3 p.m. But if the delay is long enough that it actually like it implies that the loan is received after bets close or like after the match ends, then she's not going to be able like to place the wager, right? If the credit instead is fast enough, she's going to be able to place the wager. So then the opportunity is then going to be missed, right? Which means that then she's going to have like this money that can be deployed from some other use, but that other use might also be like no use at all for the loan. The second thing that I need to highlight here is that there is a fixed cost of starting a loan with these like partners, and so that fee is going to be paid regardless of whether the loan is going to be repaid back like immediately or repaid back like on its due date. And therefore, like there is no urgency like to repay the loan from the side of like the borrower, and keeping the money actually like allows the borrower like to retain like its option value. Now, the second channel that we thought of is what we call a behavior channel, or like a household bargaining channel. So the idea here is that the disbursement delay changes like the borrower decision making. So if we hold fixed the borrower's like set of option in this case, then what might happen because of the delay is that the most preferred option changes. And so there are like some paper out there. One of them is like Kralento that show that people can change their choice because the delay shifts them away from purchasing like temptation goods. According to Gabay and Leibson, we see the waiting periods that allow people like to deliberate before making a choice can actually lead them like to make more patient choices. And then there are now like a series of studies that show that a waiting period without any choice restriction can actually like affect like behavior. So in our case, what we can think about is that the delay might allow people within a certain household, so say like husband and wife, or like male and female partners, to actually like deliberate about how to use the loan, while without the delay, the person that borrowed the money might have actually like taken the decision like by himself or herself. And then the third channel is the extra liquidity channel. So what happens here is that we have like a disbursement delay that is going to allow clients to access like alternative sources of credit. So you apply for a loan like somewhere else because you had these time sensitive like spending needs, which could be like the bet that I told you earlier. And in that case, what happens is that the client ends up like with 2 or more loans from competing lenders, and therefore like has sufficient liquidity to pay off the original loan with our partner. So we have very little, we can't say anything about the extra liquidity channel because we only have data from our administrative data from our partner, and therefore we can't see the behavior of our sample. However, we do have like some support like for the behavior channel. So the first dot on the figure up there represents like the estimate like for repayment like for the full sample. And then we have single, double, and triple interaction that consider married and unmarried, and then like same delay versus like overnight delay, and then again like that interacted with being male versus female. So what we can see first is that an overnight delay increases repayment like for married borrowers. So essentially like what this implies is, as I was saying earlier, that there might be what we call like a deliberation that takes place. So we have the extra time to talk about like the use of the loan, and there might be like a intra-household like negotiation that could improve repayment like through deliberation or through actually like getting to decide to use the loan for an alternative use. Another thing that I need to point out is that when we look at women, we have like a large effect like for married women, but then when we look at men, we also have like a large effect like for men. As a matter of fact, we have a negative, imprecise effect that is highlighted on the screen with the first like red box for married like same day like delays, but then if we look at married male overnight delay, what we can see is that we have a positive effect for married overnight delays. And while each of these two effects is not statistically significant at the 5% level, the effects differ significantly, like for one another. So we think that we have at least like a hint of evidence that shows support for the behavioral channel. What are the lessons
Sylvia,
that we can, yeah.
Sylvia, sorry to cut you off real quick. Just a quick time check. If we could wrap up in the next like 2 minutes or so we have time for Q&A and the other speakers.
Sure.
Awesome,
yeah.
Thank you.
So what are the lessons? Well, we don't know enough, like whether like the delay helped or hurt, right? So as John highlighted earlier, we don't know like what a lot of these loans are used for, right? And so if this was an important like medical need that was not met, that's definitely like not a good thing. But if the delay diverted the loan like out of like some kind of bet, that's a positive. So the pro is that really like the repayment is gonna enable these people to access like future credit. The delay might weakly decrease like the short run value of credit. And so really like whether waiting period for credit as consumer protection measures are a valuable tool is going to depend a lot on understanding like this trade-off. And then like to conclude, like for lenders, like the increased revenue there is increased revenue, but it's at limited like short run cost. And so there is concern also given these advertisement of like speed of like digital credit, that slow delivery might reduce actually like demand. Based on our conversation with our partner, this was a relationship that they were not previously aware of, this relationship between like delays and repayment. And so possibly voluntary delays like could be used as scoring devices. That's it. Thank you.